So welcome to our little Market Minute video. I'm having so much fun doing these. And so I want to talk about stock, bull, and bear cycles. And what we see is that the bull market cycles have a tendency to last significantly longer than the bear market cycles. Right now, our current bull market has really been going on since October of 2022, which is when the market hit its last bottom. So we're really 2 years plus in this current bull market. And what are some of the sectors that have done so well, right? So over the last year, we have technology, which was up close to 43%. Communications, which is done also 42%. Remember, some of the traditional tech companies got moved into communications, and so that's a little bit misleading if you don't really track and understand what's there. Consumer discretionary was up 34%. Financials were up almost 30%. And the S&P 500 was up closer to 25% or so over the last year. What have been some of the losers, right? Materials were actually negative for the year. Healthcare was basically flat. Energy was more or less flat. Real estate was up 3.6%. And you have consumer staples up about 11%, which, by the way, in a normal year, being up 11% would seem great. But when the S&P 500 is up closer to 23 to 25%, all of a sudden, these feel like laggards, right? And utilities and industrials were up roughly around 19%. Again, in a normal year, that would have been amazing. But in a year like now, we're like, oh, gee, we would have lost money in those areas. And here's how I would look at this. Instead of trying to chase the latest fad, right, the latest thing that you're reading about in the newspaper, is we want to create a portfolio that you're high conviction with, that you believe in, so it's not keeping you up at night. And when that portfolio goes down, and it will, then you can stay invested, committed, and not losing sleep because you believe in the strategies that we've employed with you. So that's really the idea here, is trying to rely upon high conviction approaches, whatever they may be. If you're interested in dividend stocks, fine. Maybe overall dividend did not do as well as technology last year, but if you feel comfortable with that, then that's okay. And so high level, that's how we approach it. And for the most part, I think the clients have been really benefiting from that approach. Okay? And with that then, thank you. Feel free to call us with any questions.